Welcome to episode 18 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Nick Huber of Sweaty Startup fame, also the acquirer of Support Shepherd, now Somewhere.com. I was very excited about this interview. Nick Huber, in case you don't know, is a content producer. He's big on Twitter, and in certain circles, he's a very well-known name. I've been following his work since probably 2017, 18. His message is one of small business entrepreneurship versus venture capital, West Coast tech entrepreneurship. So it's a message that really resonated with me. As I mentioned in the interview, it landed on me at the right time. And so I've been a fan ever since, but also as a content producer myself, I just see him as somebody that I admire as a fellow and more successful professional in the content game, as it were. And we talk about that in the role in his success, content, distribution, and you really get a sense of, Nick is kind of exhibit A of using content to further and expand your career. He talks about how being so visible because of the 400,000 followers that he has on Twitter, as well as the countless thousand followers he has across other platforms, has opened doors for him, has just completely ignited his career, enabled him to do the deal that is the subject of today's interview, the Somewhere.com deal. So he's just a, if you've heard that you should be online, that you should be producing content, and you've wondered why, or exactly tried to connect the dots about where exactly the value is unlocked there, Nick Huber is a picture of that. He's a name because of his prolific content production. Now, we also hear that having a big following, having distribution isn't a panacea. Nick tried to, or did launch multiple businesses that he thought were targeted at his audience of hundreds of thousands of followers. Some of those worked, some didn't. So while it was just an interesting discussion and to hear him say that while distribution is incredibly powerful, generating leads is, of course, where every business starts. It doesn't ensure success. You still have to operate the business and make the business successful in every other way. And as he says, perhaps my favorite quote of the interview, business is hard. Very simple, very clear. So even with 500,000 people following you, even with a very broad distribution where you can drive a lot of eyeballs and attention and leads to your businesses, it doesn't ensure success. So just a fascinating interview. And I'd also say he's a really charismatic guy. So I was just so thrilled to have him on here. Nicholas, what did you think of Nick Huber?
It was an awesome conversation. I had so much fun, and I was inspired and pumped up for several days after it. And so we talk a lot about his distribution and the reach and the opportunities that has given him. The other secret sauce we discuss in detail is how he has mastered remote work and offshore labor. And he talks about his self-storage company where his payroll is $1.5 million a year versus his same-sized competitor down the street who pays $5 million a year. So he has a 70% cost saving compared to his competitor. And you can only imagine how competitive that makes you and what you can do with that surplus cash. And it's not only about cost savings. He argues it can drive quality too. And this is interesting because SMBs notoriously struggle to attract top talent. In the US, we're competing with Google and Goldman Sachs for the best sales and engineering talent. But internationally, you can pay competitively. You can allow them to work remotely, which is attractive for many people. You can really dip into some of the best global talent. And he has done so. In fact, he did so successfully that he ended up buying Somewhere.com, which is a recruiting firm of offshore talent. So super inspiring episode, just really, really fun. And I learned a lot.
Max, what do you think of Nick Huber? You were not familiar with who he was going into this, so would love to hear your perspective on how he came off.
I wasn't super familiar, and great job. I thought it was a fantastic episode. He's a serial entrepreneur, so this was a glimpse into the mind of a serial entrepreneur who is definitely not finished yet, but is sort of maybe midway through his trajectory. So, I mean, he started off at Cornell. They started a moving and storage business in college, which he described as being, pretty much the worst clientele you can have, college kids as your customers. So he, in talking about that, he notes that he learned everything about business in running that startup, and he learned operations. And so he took that knowledge, he turned it into a storage empire, basically, and then he found remote workers to help power that storage empire and reduce his costs. And that led him to somewhere.com, where he was finding all these remote workers. In the meantime, he developed a huge presence on Twitter. Super interesting how he put all the pieces together and is now the owner of an outstanding $50+ million business in somewhere.com. I think anybody who is an entrepreneur will get a lot out of this. It's inspiring, it's fun, and he describes himself as having an irrational confidence. And I think that's what all successful entrepreneurs must have to succeed. He doesn't only talk about success, he talks about some failures along the way as well. But I thought it was a really raw and honest, interesting conversation.
We talk about independent sponsorship as entrepreneurial private equity, where in many cases, most independent sponsors come from private equity and then they become entrepreneurs in private equity by launching their own, going out and looking for a deal. And Nick kind of comes from the other direction. He's entrepreneur first and moves into private equity. So he didn't self-identify as an independent sponsor. This is de facto an independent sponsor deal, but it wasn't like he was wearing, an independent sponsor shirt. He just saw a business that he wanted to buy. You'll get the full story. He saw a business that he wanted to buy, and he figured out how to raise the capital, put the deal together, and pulled it off. So it's really quite impressive. And it was also for the audience, it was a very high profile deal. So if you were on Twitter or, in certain entrepreneur circles and that follow Nick Huber, when this deal went down, it really got a lot of buzz. So it was really great that he could come on here and unpack it. And I mean, he gave us every single number. We couldn't have asked for more detail from him, more transparency. So really, really a fun anatomy of a deal episode as well. Before we turn to it, a reminder that Minds Capital is continuing to invest equity in independent sponsor deals. So if you're a sponsor raising for your acquisition, submit your deal to us. We're always at deal@mindscapital.co. And while I'm at it, we're also getting a lot of inquiries from prospective LPs in Fund 2 of Minds Capital. We haven't launched Fund 2 yet. It's coming later this year. But if you are an accredited investor and potentially interested, there's a pre-registration form on our website. So look for that at mindscapital.co. And with that, let's hear it from Nick Huber of Sweaty Startup fame and the sponsor behind the somewhere.com deal. Enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Nick Huber, welcome to Acquiring Minds and the Minds Capital podcast. We're going to air this interview on both shows. Nick, you are known as the Sweaty Startup guy. You are known as a very large, sometimes controversial, Twitter influencer. You're known as a self-storage entrepreneur. You very publicly bought an 8-figure business, and we're going to unpack that deal in a lot of detail. And you were a personal influence to me, Nick. When I first heard your Sweaty Startup message, that there was this entrepreneurial path that was not tech and VC, which we all know grabs an outsized share of the headlines. I really needed to hear that, and I'm not overstating it to say that it changed the trajectory of my career, and I know it has for many others as well. So thank you, sir, for that message and for amplifying it so effectively in the world. Case in point, you recently published a book on that topic, and we'll want to hear the thesis of the book, the message of the book in your own words here, Nick. But before that, a selfish question from me. At 350 episodes about buying businesses, I'm often told that I should write a book. I reflexively resist the whole idea. Why did you do it? How has it gone? I know it's early days, but tell us the kind of the personal story behind deciding to write a book.
Yeah, it's an organized message to myself is what this book is. People think it's for everybody else. This is reminders to me on how to run a company, and it's what I really wish I had in my hands when I was, in the early stages. And yeah, you should absolutely write a book. It was very difficult. I grew as a person. It was harder than I thought, like almost everything I've ever done in my life. But it's been rewarding. It did not make the New York Times list, which I thought it was going to. Sales have slowed way down after the first week. So if you're doing it to make money, and if you have expectations around it, I don't suggest writing a book. But if you want to do it to get better, to have a new intimacy with your audience, I can already feel a different energy with people who are direct messaging me. Then I suggest it.
And was that so that's you reflecting back, but to do it initially, did you think it would make you money or spread the message further?
Yeah, I got a $500,000 advance from HarperCollins to write the book, which also added stress because now I feel like I need to deliver for them. It's almost like they invested in me. We have a lot of work to do to make it profitable now for them. I'm confident that we can do it over time, but they thought I could be a New York Times bestseller with an advance like that, and I'm not. So there's a little bit of pressure. There's a little bit of pressure there too.
Yeah. Well, appreciate the candor, Nick. And so now do please tell us, for those who don't know you, a lot of people listening will already, but what is the central Sweaty Startup message? You do a lot of things now, but that's really what will put you on the map. And it remains one of your central messages to people.
When you walk through any major city in America, if you took a microphone and put it in somebody's face and said, what does entrepreneurship mean to you? 90% of them will say the same thing. New ideas, new inventions, new products, Shark Tank, tech, a new piece of technology, raising money, San Francisco, Mark Zuckerberg, Elon Musk. But I've met a lot of wealthy people, so have you. 95 to 99% of the wealthy people that I know, and I'm talking generational wealth through entrepreneurship, did not go that direction. They started sweaty startups, boring businesses. They out-executed, they out-operated. So it's kind of messed up to me that 95% of the media is dominated by one type of entrepreneurship, but 95% of wealthy people went a different direction. So this book is an official call out to entrepreneurship culture.
Yeah. It's funny, Nick. Boring businesses has become a thing now. So it's a theme, it's a meme. So it may feel like old news to people, especially listening to these podcasts, because Acquiring Minds and Minds, and Minds Capital podcast, it's all lower middle market businesses. So it's people who are well aware of the opportunity in boring businesses. But as recently as 2015, 2017. This was news. This was really eye-opening to people, this message, as I said, as it was to me.
Yeah.
One other thing I'll just say is that a lot of there's been a pattern on Acquiring Minds among my guests where they've had this epiphany on their own. And there's actually a very specific pattern that's come up multiple times where they caddy at their local country club. They see the members and ask, or ask around, how are these people wealthy? And it's always boring businesses, and they have this epiphany on their own. And it's this funny pattern. You must have had that experience. You just kind of said it. But it's so there are those people who have it themselves, the epiphany themselves, but it's usually because they worked at their local country club or something. So it's kind of fun. But there's an epiphany moment. Some people have this epiphany moment where it's like, oh, it's not Zuckerberg only. That's not the only path.
The people that reach out to me weekly with the epiphany, unfortunately, are failed tech founders. They have went the venture capital route. They have tried to succeed against all odds. They have raised the money. They have tried to change the world. And now they learned a lot. They're in a great spot, but they're ready to go do something that's profitable.
Yeah, exactly. Well, Nick, we want to get into this deal that I touched on, but just before we do, give us just quickly, if you could, your bio in 2 minutes.
Yeah. So went to Cornell University to run track from small town in southern Indiana. Two middle class parents, didn't own assets or businesses or rental properties growing up. Met my business partner senior year, started a pickup and delivery storage business called Storage Squad, the hardest business in the world. 6 years later, we were at 25 major colleges, 12 states, 14 locations. We picked up and delivered 7,000 plus students a year, 50,000 plus items, 200 plus part-time employees, a lot of different warehouses. It was a brutally hard, logistically challenging business doing storage for students when they left college. 2015, we realized
terrible clientele, by the way. The worst.
I was forged under fire as an operator in that business, and what I thought was the money that I was doing it for was actually the skill set. It turned me into an operator. I learned a lot of those really hard lessons when the stakes were lower in business, which I'm super, super thankful for. Also met my business partner, Dan Hagberg, who has been a massive positive influence on my life and financial status. So 2015, we realized that was not the business we wanted to be in forever. There was only so much opportunity there. We built our first self-storage facility from the ground up, upstate New York, $2.9 million all-in basis on that deal. And then that one changed our life. I mean, we did it under we went into private equity knowing nothing about what a promote was, what a carry was. We had a very wonky structure on that very first deal, which we can touch on. But that deal changed our lives. It's worth $10 million today. We still own it. We've done some cash out refinances. Then we bought some more storage and realized real quick we want to sell that first Storage Squad business. We did so, 7 figures and a little bit of change as an exit in that business in early 2021. So we were full-time storage, bought a lot of self-storage facilities in 2020, 2021. We have 63 properties now, 50 employees. Bolt storage is the majority of my net worth. 2021, I got involved in somewhere.com as an affiliate customer at first. A year later, I bought in as a minority equity partner, 15%.
And what is somewhere.com?
Somewhere.com is an international recruiting company. And I have 325 employees across my portfolio. I have 22 Americans. The rest are international in Bogota, Colombia, Sao Paulo, Brazil, Mexico City, Cape Town, Johannesburg, Manila, all over the world, Cairo, Egypt. So we can talk about all that, but that business changed my life and how I build businesses. 2022, started a company called RE CostSeg, a cost segregation firm. And it's grown to be very large, 50 plus employees, 750,000 plus a month of revenue. A lot of potential now that 100% bonus is coming back in the new tax laws. But yeah, man, started 8 other companies in there. We shut a couple down. And then in 2024, May 1st, 2024, about a year ago, is when, I closed the big deal to acquire majority interest in somewhere.com.
Awesome. Thank you for that, Nick. And we're gonna double click on a lot of that, but 2 quick follow-ups. I don't think you mentioned Twitter in that.
I started the Sweaty Startup podcast in 2018 because I was doing some mentorship calls with my brother. He was running a lawn care company. I'm like, you know what? I'm going to start a podcast. I went all in like I do on any given hobby. And I didn't get anybody to listen to it for about a year. My friend Moses Kagan found me on Reddit trying to get people to listen to my podcast and said, Nick, you got to come to Twitter. Got to come to Twitter. Like, you're built for Twitter. And I ignored him. I was like, no, that's where people get mad about Donald Trump and complain about referees. I'm not going to Twitter. He actually called me again 3 months later and said, Nick, like, I'm saying this because it'll change your life. Come to Twitter, talk about your deals, do what you do. And I did. And he quote tweeted my very first tweet on Twitter and said, you got to follow Nick. He had maybe 3,000 followers at the time. And then it was just up and to the right from, the good old days of Twitter, which are not here anymore as far as getting followers. But yeah, now I have 400,000 followers. I've met people who have invested 50 million plus into my businesses and my deals. I've hired through Twitter, met Marshall Haas, the founder of somewhere.com, through Twitter, met Mitchell Baldridge, my co-founder at RE CostSeg, through Twitter. It's changed everything about how I do everything. It basically accelerated my career 50 years in a 5-year span.
Well, we're certainly going to spend time on that. And I actually was just on stage interviewing Moses at SM Bash a month and a half ago. We talked about Twitter. We talked about his relationship to it. You both say the same thing.
What a great human being.
Yeah. Oh, yeah. Moses is a gem and so solid character. But you both say that the Twitter, just comment on how much Twitter has changed and how the opportunity kind of is gone, at least with the current algorithm. We'll get there. One last question for the Acquiring Minds audience listening, Nick. I heard you say that I want to call it a moving business, but you were calling it something else, your first business.
Storage
what were you calling
Squad.
it? Pickup? What was it?
It was called Storage Squad. It still exists today. Zippy Shell bought it, and it does pickup and delivery storage for college students when they go home for the summer.
Pickup and delivery for college students. That it was a brutally hard business. So one of the things about boring businesses and buying them in the trend that critics will point out justifiably is that becoming an owner operator of a small business is not pushing numbers around on a spreadsheet. It is the word, in fact, that comes up most often is, in fact, brutal. Now, I mean, we could spend a podcast on this subject, but in your advocacy for sweaty startups, but also basically wanting to get out of your own sweaty startup, how do you reconcile the two?
It's my fear. My fear is that through my work on these podcast interviews, my own podcast, my own newsletter, my own X, is that I generate a era of entrepreneurs that end up 10 years in to not owning a business, but owning a job that controls every hour of their life with addiction problems and a wake of broken relationships behind them. That's my fear, because this is humbling, it's brutal, and people don't talk enough about why it's so hard. I tell a lot of those stories in the Sweaty Startup book, but yeah, you hear and you see the entrepreneurs bragging about their wins. You don't hear about the fact that I was, during a busy season in Boston, I lost 20 pounds in a 4-week period because I wasn't eating. I was sleeping on a warehouse mattress of one of our customers. I was chafing so bad between my legs that I was bleeding. I had a mental breakdown a couple of days later on the side of the road because 4 really expensive bad problems happened at the same time, and I didn't know what to do. People don't talk about that stuff.
Well, we try to. There's actually a theme on Acquiring Minds of the fetal position moment.
That was it.
Yeah. It sounds like you had one. And it's
one of the guys drove my truck under a bridge and ripped the top of it off. Another one put diesel fuel or gasoline in a diesel fuel engine, and a third one sideswiped a BMW in Cambridge, all within a 3-day period. All while our customers were calling me, and we were having a ton of just operational headaches. And yeah, fetal position moment on Buswell Street in Boston University South Campus.
Not that you remember the exact location or anything.
I do, right there on the corner store on Buswell Street in I think it's Newton, Mass. Yeah. Brookline, actually. Yeah. Brutal.
Indeed.
Those make you stronger, though. I mean, look, I think the amount of money that you make in this world is directly correlated to the amount of stress and uncomfort you can put up with. And I'm very good at putting up with it now.
Great, Nick. Well, thank you for indulging me on the book and on kind of sharing with the audience who you are. I think most people will know you, but just in case, that was great. Let's get into this somewhere.com deal because it was very high profile. I saw it all over Twitter. I was already aware of Somewhere at the time when you bought it. It was called
Support Shepherd.
It was kind of the highest profile, most well-known outsourced to the Philippines, other countries as well, but it was known for offshoring to the Philippines, kind of agency. And really, this is an independent sponsor deal, whether or not you would apply that label to yourself. You found a business that you wanted to buy first, and then figured out a way to raise that money and do the deal. So give us first how the deal came across your desk, how it came to be.
Yeah, I became a customer of it in 2021, where I hired 5 Filipino customer service reps to work at my storage company. I then used somewhere.com to build my storage private equity company over the next year, and started hiring in Colombia and in the Philippines. 2021, I was an affiliate. I was talking about it online. I was driving a ton of business to it. I went to Marshall and we negotiated a deal for me to buy 15% of the business. So I became a 15% partner in April 2022. This was when the business was 5 times as large as when I got involved at the beginning, from maybe 30, 40, 50 grand a month of revenue up to about 250 grand a month of revenue when I became a minority partner. A year later, it had, almost tripled in size again. Sean Paris came in and I got diluted down to 12.75%. He bought 15% of somewhere.com. And then the business continued to accelerate and grow. And in November 2023, Marshall, the majority owner, Marshall Haas, called me and said, "Hey, Nick, I don't have anything in writing. Like, this is very early stages, but Andrew Wilkinson at Tiny has vocalized interest to acquire 51% of somewhere.com at a $47 million valuation. What do you think of that? Would you want to sell half your shares?" And it's one of those moments in my career where, as a small town kid from Indiana, taking $3 million off the table, that's not generational wealth, but that's life-changing money for a guy like me. I instead spent the next 2 months convincing him to sell the majority of the business to me instead.
What was the reason back in 2021 that he let you buy 15%?
Because he knew that if I left and started a competitor, the business would not grow as much as it was today. So it was a very, very good deal by Marshall to do that. Looking back, I probably should have started my own, but he's also a great operator and he had a ton of value. So I think it was a win-win situation.
It was carrot and stick. It was, Marshall, I might start one of these because I have an incredible audience to drive to it. So don't you want me to drive that audience your way instead?
Yeah, exactly. And I think by a year later, it was my number one source of income. Frankly, I was 30, 40, 50 grand a month of income coming into the business, coming into me personally from this business. Wow. So life-changing.
And then the business continued to grow, and now you had a vested interest in it growing as well. How were you involved beyond marketing it and advertising it on your social media?
Yeah, I was a customer of it. I was building now all of my companies. We had expanded to Latin America through kind of my urging, but operationally I was not involved. Ben Sermon was the COO, a very, very good operator. Marshall was the CEO, and they did their thing until I acquired the majority interest.
And so when he got this offer from Andrew Wilkinson, 47 million, was it? Mm-hmm. To buy 51%. How did that play out?
To clarify, $47 million enterprise value,
right,
acquiring 51%. And there was early discussions about how it would look. It would be some stock. It would be a little bit invested over time. But it was pretty much became an open conversation. It wasn't me on one side of the table, Marshall on the other side of the table, Andrew over here. It was all of us talking together about how to do this because Andrew needed me to be in the business to make it work long term.
Right.
And we kind of worked together about, hey, and actually in the end, Andrew kind of lost interest in the business because he got very afraid of the AI risk, artificial intelligence risk to what we do.
But when he was still interested, Andrew Wilkinson of Tiny, he needed you again because of your Twitter distribution. So this was right?
Yeah, he wouldn't let me sell all the way out. And I wasn't even sure if he was going to let me sell 51% out because he needed me to have a vested interest in growing the company for sure.
You had really become strategic to the business. You're promoting it on Twitter.
Yeah, I was sending 20 to 30% of the company's revenue to the business with my audience.
And so at this juncture, the founder, he's awaiting this offer from Andrew, who's trying to navigate some kind of a deal structure where you are still involved. But instead of kind of playing along on this, you come in with a counter offer. So how did this play out? Did you have to go higher in price, or could you in fact go lower because you had the strategic angle?
It was about the same value. It was going to be more cash, less stock. So that was kind of the advantage. But again, it was me and Andrew talking about how we might put this deal together. deal together as well. It wasn't me against him. It was maybe Andrew comes in and does the takeover, and I am involved in a bigger way as well. Almost he's like an investor in the deal. There were so many moving parts of how to structure it, what to do. And Marshall's first question obviously was, where are you going to get $20 million? Like, this doesn't make any sense, Nick. How are you going to pull this off?
And so instead of selling down, this became a conversation about, okay, how can Nick get involved, almost like a co-sponsor with Andrew, and we do this together, cash out Marshall a little bit so that he gets a good payday, and then we get an increased strategic interest in this asset that we so believe in and are building our businesses around.
Exactly right.
And Nick, you wanted to become an owner, or more of an owner, or didn't want it to go all the way to tiny because you were such a believer in the business, and this was just an opening to start, talking about maybe becoming the owner?
Yeah, I thought that this was the first business that I had been involved in that had $500 million revenue potential, over time, obviously. This is a business with a model that's proven. There are 100 plus companies in the United States that do this and make more than 100 million a year of revenue. Big industry. The demand is not going to stop, in my opinion. So yeah, I thought, I don't want to own less of this. I want to own as much as possible. And man, I think the common theme throughout my career, from doing that very first uniquely structured storage deal to raising the money in the storage business from the beginning, is I have almost a irrational confidence at times, and that I can do it. I think my dad instilled that in me as a kid, that, hey, like, nobody's going to give you permission to do this, but if you believe in something, don't be afraid to take the big bets. And I thought I would regret, when the bell was ringing someday on the New York Stock Exchange and somewhere.com is going public, I would probably regret selling a lot of equity and not taking that swing.
And Nick, when you talk about, say the stat again, that there are 100 other companies in the U.S. doing over 100 million in offshoring. Did I get that right?
It's a true stat I made up. It's one of those. There's a lot of very large businesses. A lot. There are at least 100 companies in the United States doing exactly what somewhere.com does that are larger than somewhere.com. There's full skyscrapers in Manila and Johannesburg and Cairo and Mexico City and Bogota of companies that are doing this at scale, much more mature than us. And
certainly, offshoring is a 30-year-old story. We hear about I think that some of the earliest stories were developers. Maybe that's my tech orientation again, but developers in India, for example, have been happening for decades. Yep. So what is the market positioning of Somewhere? Is this like SMBs are only now starting to take advantage of it? Where is the niche of Somewhere versus this kind of big corporate offshoring that's an old story?
Yeah, the niche is that we are building. It's finally an area. We read The World is Flat book back in 2002 or 3 when that came out. But technology is finally to a place where you can truly have a worldwide diversified team operating in sync, with no BPO, with no business process outsourcing firm in place to handle everybody. I can run a company right here from my basement in Athens, Georgia, with Slack, with Notion, with Asana, with Fathom, with G Suite. I can run a company right here with my finance department split between Cairo, Egypt, and Johannesburg, with my sales team in South Africa, with my admin back office in the Philippines, India, and Pakistan, with my developers in Eastern Europe, with my operations managers in Colombia, with my legal team in Colombia, with my HR department in Sao Paulo, Brazil. So we have a company now that there's teams of recruiters that work with each of our clients that can build a truly worldwide team and tell you where the best talent is in the world and have you go get them. And then there's no ongoing fee. We're one of the few where they pay an upfront fee for us to find somebody, then they own that relationship instead of paying $1,500, $2,000 a month upcharge, to handle compliance, basically. So it's just much easier to build a worldwide team now.
And so as a client, you've seen this firsthand with your self-storage business, and you have 50 employees there. Many of them are remote. So how does that manifest in the operational expenses?
Oh, so, I mean, first of all, since I acquired, this is a very complex story, so I hope people can follow. When I acquired somewhere.com, it was called Support Shepherd. I bought somewhere.com for $400,000, changed the domain name of the company, rebranded it. That's risky. 80% of the placements were in the Philippines when I bought the company. Today, we are 40% South Africa, 40% Latin America, and less than 15% Philippines. So we've made drastic operational changes to the company since we acquired it. That comes with challenges, which we can discuss. But in my own businesses, everybody thinks, and I thought for a long time, that if you want somebody to do repeatable tasks and answer the phone, hire somebody in the Philippines for $800 to $1,000 a month. We still have a ton of phenomenal Filipino employees. We're not going to ever stop hiring there, but we've had a new look at where in the world we can find very specialized talent for sales, for finance, for operations. That has been a total game changer for our clients and my businesses, frankly, like just how I build and how I think about businesses. And sales is, a very stark and clear example of that. At my storage company, Bolt Storage, we had a full Filipino-based call center to rent storage units. We were converting new clients who called to rent a storage unit. We were converting them at 32%. If 100 calls come in, 32 of them become our customers. We rebuilt our sales team and our customer service team in South Africa. And our conversion rate's 41% now. I don't know if you can conceptualize the power of what that means, that scale. But we have 15,000 units. The phone rings 200 times a day. We have $100 million worth of real estate that depends on revenue and stuff from this business. The publicly traded storage companies, Extra Space Storage, Public Storage, they posted year-over-year revenue decreases in Q1. Our revenue went up 14.1%. Our net operating income was up over 20% in Q1, year over year. Massive, unspeakable value to my business to increase my conversion rate from 28 to 30, from 32 to 41%.
So, right, so that's on the revenue side. You've increased your closing rate from 32% to 41%, roughly a 30% increase just by switching the dynamics in the sales force. So massive jump on revenue that can come from that by having more specialized staff. What about on the cost side? I have to imagine there's a benefit to there as well. That's the whole point of offshoring for most people.
Yeah, we have a real estate private equity company that manages 300 plus investors. We do investor relations. We manage 16 bank relationships now. We have 20 plus open deals at any given time. I can run my entire PE company, management company included, with 50 employees for $1.5 million a year. $1.5 million a year is my overhead as a business. My competitors here in the States, my friend runs a very similar size shop in Atlanta with $5 million a year of annual overhead. So it just decreases the risk. It allows me to hire ahead of revenue. It allows me to make a profit through really difficult times. We can talk about how difficult the last 3 years have been in the real estate business and how this frankly it saved us as operators.
So 1.5 million of OpEx versus 5 million for a similar sized competitor. This is a 70% reduction in overhead. Just can you elaborate on what that means for your competitiveness as a business?
I would not be able to operate this many storage facilities with the fees I charge my deals, the management fees I charge my deals if I were hiring only Americans. I would not be able to. So yeah, it's the difference. Like we were able, through the last 3 years of brutal real estate environment, we were able to toggle off management fees at 4 of our deals. Turn them off. And it's fine. We're still break even or better as a management company. It's a game changer.
So this is an example where because your overhead is so much lower, you can provide a lower price to your customers. You can provide a better investment prospect to your investors, and you can take home a better economic deal for yourself as a sponsor because you're putting all of this together.
Yeah, and I think it goes without saying, but if I now think about hiring and building divisions of my company at a worldwide level. So I'm gonna go find an analyst in Cairo, Egypt, who can work magic in Power BI and Microsoft Excel for $700 a month because Cairo is the most affordable city in the world to live. I can find a salesperson who speaks perfect English with a smooth British accent for $2,000 a month. For account executive, $200,000 a year US equivalent, right? Operations talent, legal assistants for $1,500 a month in Bogota, Colombia. It's, developers in Eastern Europe for $3, $4, $5,000 a month when you're paying $200,000 in the United States. It's my ace in my back pocket when I acquire companies and when I build my businesses.
Does it also drive what kind of businesses that you will buy and start in the future?
I think it does. Yes, I'm invested in a pest control business. They didn't do 24/7 customer service. They didn't have trained salespeople with a sales focus on their phones. We're running the same plays. We're running the same plays at every business. Ari Koseg, we're hiring aggressively for sales talent in South Africa. Somewhere our account executives are now South Africa. So it's my strategy. It's my playbook now to acquire companies. Now, am I going to acquire another company anytime soon? No. No, we can get there, but yeah, it's a different way to think about building a business for sure.
And it plays particularly well to labor-intensive businesses, it sounds like.
Oh, and even back office of in-person businesses. Yeah, like there's no reason to pay an accountant $125,000 a year or a controller of your business $200,000 a year when I have a head of finance in Joburg who ran a 300-person company and he's $4,800 a month to be my controller at one of my companies.
I was surprised to hear you mention a pest control company as the first example, because that's field employees, which you really can't have remote. That's the whole point. But you're saying the back office element and the call center element can be outsourced. And in there, you can save money and also provide better quality by being 24/7.
Oh, like, let's just work through the funnel. Your digital marketers are overseas. Your call center, obviously, in sales is overseas, but your billing, your logistics, the people who make your routes, like collections, then your finance arm of your business with financial planning and analysis, all the way through to revenue operations, like follow-up sales, enablement is a massive division of these large companies. There's no limit to who you can find. And I thought 5 years ago that it was an assistant to do repeatable tasks. So yeah, it's the game is changing in my opinion in a unique way.
You would think that sweaty startups would be the type of business that where offshoring doesn't make sense. It's in the name. Sweaty, it implies in-person, local service delivery. But really, just as you just took us through it, what you realize is that in sweaty startup or super hyper local in-person field style businesses, indeed the service delivery is local and physical. But basically, if you really examine the organization, almost everything else doesn't need to be.
Yeah, I operate 63 self-storage facilities. There's nothing sweatier than 15,000 boxes that need to be swept and spiders out of and mice out of and people moving in and out and leaving garbage and snow removal contracts and electrical repairs and gate repairs and landscaping. My team in Colombia does full property management. They speak Spanish. They speak to half of our vendors on the phone in Spanish. It's technology is pretty insane right now for what you can do remotely.
But so how do you go about this? Just hiring one or two people on Upwork doesn't seem to kind of move the needle very much, and it's hard to find the quality maybe on the first try. So how do you go about mastering this remote workforce?
It's really hard, and you don't have to use somewhere.com. This is not a pitch for somewhere.com. Do a typing test for anybody that you hire internationally. Typing speed, we get 30,000 to 40,000 applicants a month at somewhere.com. 30 to 40,000 applicants every single month that want to work. 90% of them can't type over 40 words per minute, which makes them virtually incapable of running working for a remote business. So do a typing test at the beginning, give them some test work, make sure that if they're in an area like South Africa where there's rolling blackouts or the Philippines where there's monsoon season and hurricane season, there's a lot of logistical things to worry about. And, but the typing test is number one, like make them do a typing test. And
so what are the thresholds? What speed do you need to type at for various positions? And what do you type at?
I type 100 words per minute. I hire anybody over 40 words per minute executives over 60, obviously admins, customer service who do typing, queries much higher. But yeah, it's tricky. The Philippines types a lot faster. Latin America types the slowest in general. South Africa, there's just a massive disparity. A bunch of people who type 20 words per minute and a bunch of people who type 70, 80. So it's directly correlated to work performance though from a remote team.
Great, Nick. Well, thank you for kind of explaining the whole value prop here of somewhere.com. Let's turn our attention back to the mechanics of how you actually put this deal together. Mm-hmm. Can you kind of give us the outline there?
Yeah. So I was in a dilemma because I'm used to the real estate business where, you do a 7 or 8% preferred return, and then you get a 30, 40, 50% promote, which is a carry we call a carry a promote in the real estate business. I realized after 2 or 3 meetings with capital investors for small business that there's no such thing as a 50% promote. The cash calls the shots. So if I was going to acquire 51% of the business after you take out me and Sean who don't want to exit, if I'm going to buy about 40% from Marshall, I'm going to raise $20 million to buy 40%. But after it's all said and done, I'm going to own an extra 8% of the business because I'm on a 20% carry. So I'm going to go from 12.75% ownership to, 20.75% ownership, and I'm going to raise $20 million. I'm going to put my reputation on the line, and I'm going to go through the headache and stress of buying this company. Would you do that? I decided that no, I have to find a way to get more upside for myself in this business. So it was not necessarily a retrade, but it was kind of me going back to Marshall and saying, hey, look, I need to buy more of the company. Buying 39, 40% of it does not work for me. I need to acquire like 58% from you to make this worth it. And it all needs to be from you because I don't want Sean to be diluted because he's sending a lot of clients. You own about, 70%. I want to acquire 58% from you. So he had to come to terms with giving up more of the business. And what we ended up settling on was a 39.25% equity tranche from investors. $20,300,000, what I'm going to buy outright, 39.25. So the value of the business over the 3 months of negotiating, it accelerated. We just settled on a $52 million valuation versus 47 because the business had started to grow. 39.25% in a private equity tranche where I'm going to get him cash. But then I need an 18% seller note on top directly to me. That's collateralized by the business itself. And there's an acceleration in the interest rates. There's tax implications of that I had to think about as the distributions came out. After I paid interest, it was all taxable income to me. So I couldn't pay principal down with all of that. I had to, withhold 50% of it to pay taxes with. There's a lot of complexities to the deal, but I had to figure out how to make it worth it for me. So what I ended up doing was I owned 12.75% outright. I did an 18% seller note from Marshall directly to me. And then I did 2 private equity tranches, one with a 20% carry because they invested more than $1 million in the deal, and one with a 30% carry if they invested under $1 million in the deal. So those blended together, it was about 32.96% with a 20% carry, 6.29% with a 30% carry. Blended, it was 6.5% for one, 1.8% for the other, 18% seller note, 12.75% I already owned. If the deal went well and I got everybody paid back, I would own 39.229% of somewhere.com. And that, for me, was worth it.
So let's unpack the sources and uses a little bit in what you just laid out there. And thank you for the transparency. That's awesome.
Yeah, so it was about $9 million in change that I borrowed from Marshall. That okay. Money didn't technically change hands, just the equity changed hands in exchange for a promissory note that the company was collateral for.
But of 100% of the stock prior to your transaction, you own 12%, so you're rolling that. Mm-hmm. Sean was rolling his 15%, give or take. Mm-hmm. And then Marshall was rolling some percentage of his. So in total, the rolled equity was roughly 30%. Is that right?
Yeah. Marshall still retains about 13.5% of the company.
And then the buyout element here, changing hands, effectively was 70% of the business, of which 50 of those 70 was a pure kind of cash payout.
No, so it ended up being 58.25% of the business that changed hands.
Okay.
Because now I'm 70% control. I already own 12.75. So 70 minus 12.75 is 58.25%.
Right.
Or 57.25%. Yes, 57.5 is what changed hands. 18% of that seller note, the rest cash.
Right. Okay. Bear with me here. I have follow-up questions, which is why I need to get to the bottom of it. So 58% is changing hands, 42% is rolling. Of the 58% rolling cash, I think about 2/3 of that was the private equity portion, as you call it, which was funded by equity investors.
Correct.
And then the 18 percentage points, I think roughly, it was a seller note that Marshall provided. And this was directly to you as a buyer. So you bought 18% directly with a seller note instrument.
Correct.
And then investors, which you sponsored as the sponsor, where you had somewhere between 20 and 30% carry, was bought by outside investors. Do we have that right?
Absolutely right.
Give or take. Okay. And so then you say that within each of these elements, you had different financing terms. So first of all, you had a seller note that you kept separate. I have to imagine that you disclosed that to the investor that, hey, you're getting no leverage, no benefit of the side tranche here, but I'm doing it in order to effectively as part of my GP compensation, because otherwise it's not worth it to me.
Yeah, and the seller note had to have no adverse effect on the equity that was acquired, meaning Marshall can't claw back or get first right to any cash flow or have any retaliation to the entire company, right? He could only claw back that 18% equity in the event of default.
Right. Okay. So it's junior to the other 80% of equity, which is then preferred or senior in some way. Mm-hmm. I haven't really heard about this before, where a sponsor effectively carves out the seller note and takes that as a benefit for himself. So that's very innovative and creative. Was that controversial in any way?
Not really. I just told the equity investors that story of, hey, look, like, I don't want to buy this thing and put my name on the line and raise all this money for an 8% upside in this. Like, I'm going to be way too involved, putting my reputation on the line. There has to be a carrot for me. And yeah, I met with 100 investors to raise the money from 38 people. So several of them didn't like that I didn't put a lot of cash in, for example, or they didn't like the seller note aspect.
Why would the seller note be something that investors don't like? I'm missing that. Or because they're not participating in the leverage?
Yeah, they might want the juice of that seller note instead. Even though it was essentially for investors, it was not really in existence because the equity is treated just like their equity. But yeah, they would want the juice from it.
But the pay down of the seller note, is that paid out of just 18% of the cash flow or fully paid down by the company overall?
That's the difference, is that it's only that 18% equity that can pay down that note.
And so where other investors get dividends, your dividends go towards paying this down.
Correct. My 12.75% still comes to me in cash. That 18% goes into a separate account, pays the note interest first, and then there's a tax. There's 15% of it is put in a tax account that I can only use to pay taxes, and 50% is used to pay Marshall's pay equity on top every single month.
Right. So there's still no juice for the investors, but at least they're not harmed by this instrument on the side.
Correct.
And then for the investor side, roughly 39-40%, you said that you had two tranches, one for big investors and one for small investors, where small investors would have to pay 30% carry and 1 million and above pay 20% carry. How did that go down?
Yeah, I just met the market basically with what I needed to do. There's no pref, there's no waterfall. A lot of investors said no because they wanted a waterfall. They wanted, the carry to end up at 20% and start at 12 till a certain multiple on invested capital, then go to 15. I just made it simple. No pref, no fee, no AUM fee, no pref, 20% carry after their distributions equal their invested capital amount.
Yeah, but I mean more the bifurcation of small and big investors, because most investors like to be pari passu.
Mm-hmm. Yeah, I think if you're going to put $1 million into a deal, you deserve a little bit of extra juice. And I had to find a way to incentivize folks to invest enough money for me to close this deal out without having 150 investors that I have to deal with. So my goal was incentivize people to put $1 million in, because then all I need is 20 investors to get this deal done.
Is that something you'd used in your real estate deals before, Nick? That bifurcated? No,
never have.
But I do suppose you often see an anchor investor, a big family office will come in and get a discounted carry. Now, of course, that is discounted from the standard 20%, and not that small investors pay a premium, which is how I interpreted this first. But from that angle, I guess it's right. You're saying these anchor investors, they are more valuable. They're coming in with more cash. It's a bigger commitment, so they're going to get a discounted rate to the fee everyone else is charged.
Exactly right.
And have you been able to keep everyone aligned since the transaction happened? It's been about a year now, you said. And has this deal structure worked also post-closing?
Yeah, it's worked great. We've had, everybody's still in the deal. Haven't had any requests for buyouts. And generally speaking, I take a meeting every couple months with investors, but largely very respectful.
Thank you again for the transparency. It's awesome to learn about innovative deal structures. And last question on this, for me at least, is you got what I would consider above market terms there, because 20% carry is market, more or less. And in this case, you got 30% on a tranche of the investors, plus you got the seller note instrument on top of that. So massively better terms than what I would consider market for independent sponsors. How do you think that you positioned yourself to negotiate that kind of leverage?
Yeah, it's I had access to a lot of capital. I had 300 plus active investors in my real estate business that have worked with us for 4, 5, 6 years and can trust us. I had a big reach through the deal to additional potential PE shops that I could go take meetings with. Sophisticated investors. I didn't raise money from non-accredited or retail investors, but yeah, it was definitely salesmanship and me having to, tell people, hey, look, like here are the risks of this deal. It's AI, it's competitors, it's Twitter might not work. We're rebranding, all these things that are changes. But if you believe in me as an operator, if you believe in the future of this business, then this could be a good investment for you.
So profile and track record counts, but I have to imagine that you were already an insider and had already driven this company towards success. It's on a good trajectory, must have helped too.
Oh, the growth trajectory of the business absolutely helped, but I didn't have any resume of raising for an operating company, especially $20 million, or hiring a CEO or building a management team. So yeah, I didn't have track record. Nobody was going to say, oh, it makes perfect sense. Nick's done this before.
And how did you see that as pushback a lot, that you're basically doing your first independent sponsor deal? You have deal making experience on the real estate side, so you're not coming in totally cold, but you're not a former finance guy. You're not a finance guy.
Yeah, I did not hire a banker. I'm not a former PE guy. I was still calling it a promote in these meetings because I didn't know they call it a carry. So yeah, it was very unique situation for sure. And frankly, I don't have a past doing this. Like I didn't know exactly how it was to be done. Like, of course I called Brent Beshore and, a lot of folks who had done it, but the pushback I got was that at closing, I only wired about $375,000 to buy this business and to get this seller note and to take control. Me personally. But I already owned 12.75%. I was already making, $70,000 a month in distributions from this business. So I had a hard time with that on a couple investors, but for the most part, they're like, doesn't really change much here.
Well, and walk us through that actually, Nick, a little bit more on the skin in the game perception here.
Yeah. Some investors said, hey, like what amount of cash are you putting in? And I said, well, at closing, I'll wire $370,000, most of it to fund an operation account. Because the 18% seller note we needed to fund the account with $1.5 million at closing just for operations. So that's 18%. That's 250K. Then I had my other equity tranche that was kind of cash out, cash in, but under $400,000 in the deal. And some investors didn't like that, and they said no because of that. But it was a minority, obviously.
And Nick, going back to kind of figuring this out as you went along, of course, in any sponsor deal or any private equity deal, the returns pro forma to the investors are shown very clearly: base case, down case, upside case. What did you show there? What kind of returns were you looking? Are you kind of pro formaing out, or multiple on invested capital? What's the game plan to return investors their money plus the return?
Yeah, that's where I was totally shooting in the dark, and I made it very transparent with investors that, hey, look, this business needs work. Like it's a rocket ship that has a great customer base and a good trajectory, but there's going to be management changes as we get this thing ready to scale from, the revenue that we were doing to the revenue that we needed to do to really grow the company. We're going to increase expenses. It ran incredibly lean. So yeah, it was. I did the base case and the bull case, but with operating companies, it's not as straightforward as real estate, as you know.
Yeah. Yeah. But were you saying to them, 30% IRR is what I'm projecting in the base case? Were you hanging the investment fundamentally on an IRR or MOIC number for them? Or was this more kind of like a venture style, this thing's going to grow, it's growing a lot, it's a rocket ship, I don't know where it lands, but just get on this rocket ship, sort of more amorphous rather than a specific IRR or MOIC?
Yeah, our goal was not to sell the company, and we made that very clear at the beginning. I don't want to sell somewhere. I would like to own it for a very long time. It'll never be, unless we get a bunch of recurring revenue on the books, it'll never be worth more than 5 or 6 times EBITDA ever. So why would I sell something and pay a bunch of taxes for 5 times earnings, and then deploy the capital into something that's not going to generate me a 40% yield after tax capital? So made that pretty clear with investors that this was a cash flow long-term hold play.
And did you get pushback on that from certain investors? Yeah,
there was a lot of, there were 100 meetings with 100 different groups, an hour long. Some of them were short. They found out I wasn't putting a lot of cash in. I think I talked to Mr. O'Shaughnessy for 4 or 5 minutes, and then he found out I wasn't putting any cash in, and he said, "Nick, I really wish you the best, but it goes against kind of what we're looking to do." So yeah, there was definitely a lot of very tense conversations with investors, very tense ones, uncomfortable.
And on the long-term hold or the indefinite hold or the permanent hold, you mentioned that you called Brent Beshore, who's the name, of course, who runs Permanent Equity. So this is right up his alley. And many sponsors that we talk to, more and more, it seems, don't want to do the 5 to 7 year traditional private equity exit plan. But it all sounds great in theory until you start talking to investors and LPs, and they say, yeah, but when and how am I going to get my money back exactly, please? So what's the answer? Just basically dividending them out, or is there a recap plan potentially at some point?
Yeah, it's cash flow. Like, hey, we're building the business here that we're buying for less than 6 times earnings. We're going to assume that it's never going to be worth that, but it spits off cash, and we're going to do that. And if I can get all of your money back, and I'm getting 40% of the cash flow of this business, there ain't no way I'm going to want to sell it either. Like, let's ride this thing.
Mm-hmm.
So you went into this deal, in your own words, a little oblivious of how private equity works. Do you think it would have helped you and given you an even better outcome for you personally if you had been a serial deal maker? Or do you think more knowledge actually could have hurt you in this case?
I think more knowledge would have hurt me, just like my very first storage deal. Going into real estate private equity, we raised money to do a $2.9 million storage development project where we raised 20% of the capital for 20% equity, and we took the entire bank note as our equity. And when you do that on a $2.9 million deal and it turns into a $10 million deal, you make a hell of a lot of money. So absolutely, if I'd have went in there with a pref and a promote into that very first deal, I would be $2 million less wealthy than I am today if I'd have done that.
Those are self-funded search terms, more or less, Nick, by the way. So just for the self-funded searchers listening, understand that in the world of finance, the deal that self-funded searchers get, the terms of these deals are just unheard of. You got one for yourself, Nick, but you're pointing it out as such an exception, not the rule.
Yeah, we switched off of that structure very quick on like deal number 4. I think we switched off of it.
But such an interesting point that Nicholas makes, that not knowing allowed you to command better terms It is. It's kind of like part of it is just the sort of the ignorance of how audacious your offer was. So that's good. But on the other hand, it's striking that you could find takers.
I didn't find very many takers. I found 6 people who had never invested in a real estate private equity deal to do that first self-storage deal. One of which was I was so scrappy. The agent, the commercial real estate broker who sold me the land for the development, was the last check in for $125K. The guy who sold me the land and following me through the town hall permitting and watching me work for 6 months to get this deal permitted to even start building was the last check in, and his check cleared. And next day we paid the earthwork guy because we needed the money desperately. First check in was my dad with $125K. He mortgaged my household home to make that investment and did not tell me. He had no business putting $125K into that first storage deal. I'm very proud to say that I wrote him a check for $500K when we bought him out. But
amazing.
Still,
yeah.
He had no business doing that. I'm glad I didn't know that he did that.
Yeah.
Or it would have made me even more stressed about the whole thing.
That's such a wonderful story. Wow. Well, friends and family money is where a lot of people start. And I guess it allows everybody to just be ignorant and bet on each other sort of thing.
I think if you're a good person and you're going to treat people fairly, that rubs off. But yeah, I don't know how it's commanded those terms. I have no idea. There's no reasonable explanation. I would never invest at those terms if I was the capital partner.
Yeah. But to Nicholas's point, it wasn't just that first real estate deal. It was somewhere as well where your ignorance of how private equity is done allowed you to ask for aggressive terms. And yet this time you were in rooms with real sophisticated people, and you still got them. You still got these terms. Still got good terms.
Yep.
So in your case, it wasn't just because you go back to friends and family. It's just even from sophisticated capital. Do we
want to talk about how it went now? How it's going?
We do, actually.
It's been brutal. It's been hard. So a couple of things happened. We rebranded the business, and our SEO, our organic traffic, went from 400 leads a month to 0. So we stopped showing up on search. It's finally in Q1 of this year back to where it was when I acquired supportshepherd.com. So that happened. The Twitter algorithm changed, and my tweets that used to drive 3,000 to 4,000 website visitors and 200 leads don't work at all. I can't drive hardly any business to somewhere.com through Twitter posts. And the competitive landscape has exploded as well. So those 3 things all together, accompanied with me virtually divesting from the Philippines and moving all of our recruiting to South Africa, Egypt, Latin America, a lot of operational changes, a lot of talent that the business needed, has been phenomenally rewarding, phenomenally humbling. I've learned a ton about business that I thought I knew a year ago that I had no idea. I've learned a lot about building management teams. But yeah, revenue in Q1 was up 26%. So still very happy with how things are going, but it's been a wake-up call to me thinking that I was going to buy this business and passively install a CEO and ride off into the sunset as the business moons. That did not happen.
Well, Nick, we talked about, I heard you say that Andrew Wilkinson's initial interest waned when he thought about the threat of AI to this, which we should talk about. But now you're making clear that another, frankly, big weakness to this business was the platform risk. It was highly dependent on its SEO and highly dependent on the Twitter algorithm. And if either of those change for whatever reason, which they both did, leads collapse.
Yeah, we went from getting pointing that out. we went from getting 1,500 leads a month to getting 700 leads a month. Half.
Wow.
I was just going to take a step back there, and I was thinking about it from a Minds Capital perspective. So when we invest in independent sponsor deals, and we would have loved to consider this when it was up for consideration, there are 4 main sections we look at. Market, which in this case, AI is a risk, and you have brought up a couple other items as well. Target, and in target, we like to see, that it's growing, profitable, sustainable as a moat, all these common things. But more than anything, we like to see differentiation. And in this case, the differentiation arguably was the link to you and some of the outreach it had. Sponsor, here you have a sponsor who's delivered strong returns to investors in the past, albeit in another industry, but also a sponsor that is already an insider at the company. So this would have been a big, big plus on this deal.
Yeah.
And then lastly, the deal terms, which somewhat controversial, but actually, as we fleshed it out, eventually it comes across as more of an all equity deal with no leverage, because the seller note is really like a side vehicle that doesn't impact. So I think we could have gotten comfortable with that as well. So that's how I would have thought about it going into it. But yeah, as you're saying, it could seem like a slam dunk on the front end for an investor, but every small business has yellow flags, and there's no business that has a straight line.
Yeah.
And it's super interesting. So what has happened to revenue in particular over the last 12 months?
Yeah. So Q1 was really good. I mean, things are looking very good. I'm excited about spring. Q1 revenue, 26% growth over last Q1, which was massive. So yeah, we're still highly profitable, still making distributions every month. But then the tariff liberation day, like there's just little things about this business where, in April, we had a $250K reduction in revenue over March because tariffs were put in, and almost all of our physical product goods, e-com goods, direct-to-consumer goods, they all froze hiring. We lost 50 deals in our pipeline. We have 400 deals at any given moment in our pipeline. A lot of them paused, canceled. The pipeline behind it is really good. So it's not a long-term issue for the business, but those little blips, you just don't see that in real estate. You don't see the president making a tweet costing the business $250K in revenue in 1 month. You don't have that in self-storage.
And when you're talking about deals and pipeline here, you're talking about recruiting engagements, right?
Yeah, clients who engage us to do recruiting. We're seeing a lot of very positive trends heading into the busy season for that. But yeah, it's there's always stress. And the more I talk to people who do this, the more I talk to Brent, and I haven't actually talked to him recently. I don't want to make it sound like him and I are close or anything. He was not involved in this deal. As I talk to people who do this, almost all of them unanimously say, "Oh yeah, the first 18 months is if you're going to make operational changes and prepare a business for growth, like it's not up and to the right for 18 months. Like it's a struggle."
Have you been acquainted with the term J curve yet, Nick?
Tell me.
The J curve, if you imagine an XY axis and the line on that axis, the direction of time and revenue, it dips before it goes up. And it's kind of overused, but the point, strictly speaking, it means that you make investments when you first buy the business, so profitability goes down, but you're positioning it to then go up quickly after that. But the way people use it is just simply that the transitions into a new business absolutely sucks. There's all kinds of unforeseen stuff, new costs, new expenses that you didn't expect, and things just are bad before they're good, essentially is what it really encapsulates for a lot of people. Yeah.
Yeah. So I've ridden the J curve, and there are months of euphoria when you crush, we had a 40% growth month recently, and we're all feeling like we're on top of the world. And then there's the liberation day where you're like, gosh, keeps you up at night. So it's just the, normal passive ownership of a business.
Nick, by the way, so with this devastating SEO collapse and Twitter algorithm change that caused your reach to collapse, how did you recover from that? So how have you gotten leads back up and actually had a stronger Q1 than a year ago?
We have drastically improved the customer experience. Drastically. We present better candidates faster than anybody in the business. Our repeat business went from 1.2 placements on average to 3 placements on average. So our clients are coming back for more and more and more talent. And then we do some referral stuff to bring in new business, but we have yet to figure out like a real paid growth channel for this. I think it's outside sales and inside sales that really separate these companies apart. That's why we're super, super tuned in to our close percentages by cohort. And I'm watching every single salesperson, and I'm watching our sales close rates go up, frankly. So yeah, it's working every part of the funnel, from lead, where it comes from, to how many of them book a meeting. how many of them engage for search, how many of them actually hire and pay us, all the way through. So yeah, I'm learning a lot about operating.
Yeah. Well, it's one of these where the pain of a crisis forces you to strengthen the organization. So this is all you're emerging as a much better organization, better sales motion, tighter funnel, better upselling, better retention of existing customers and expansion of that revenue. All stuff that would have been sound to target anyway, but you're just kind of forced to prioritize
None of my recruiters were on variable compensation. Now they're on over half of their compensation is variable. Their best recruiters are making very good money. Same with sales. There's no variable compensation. There was no sourcing efforts to run ads and do LinkedIn outreach and find referrals for the best candidates that have jobs. So yeah, it's just improving every little part of the company that over time shows itself. But the first year, those things take time.
Walk me through where your executive team is located. Are they remote? I presume so.
Head of finance is in Joburg. Head of revenue operations is in Joburg. Head of sales is in Joburg. Head of recruiting ops is in Cape Town. Head of sourcing is in Manila. So yeah, it's the leaders of the company are in South Africa. I'm learning a lot about building executive teams worldwide as well.
And on our pre-call, you said something about a major workforce coming from South Africa every tax season to the United States to do Fortune 500 taxes. Can you remind me what you had said about that?
Yeah, every year, 30,000 chartered accountants from South Africa fly to DC, New York, Philadelphia, and do corporate tax and audit work for Fortune 500 companies and Price Waterhouse, Deloitte, and so on. So there's a massive finance culture and sales culture in South Africa. And so, yeah, when they go back to Joburg, they don't want to hit the road for 4 months again and be away from their families. So they want to work remote for US businesses. And, $4,000 a month puts you in the top 0.1% of earners in the whole country.
And Joburg is really the financial capital of the continent, is it not?
Oh, yeah. It's just like London, just like New York City, as far as the work culture there. Mm-hmm. There's some massive issues in South Africa with the government, the corruption. They raised billions of tax dollars to rebuild the power grid, and the politicians stole all of the money, so the power grid does not function. Like in the hot season, it's winter now, but in the summer, there's load shedding in every major city for 4 or 6 hours a day with no electricity and no AC.
Yeah,
they're living in South Africa with no electricity, which is a basic fundamental thing. Those are issues you don't run into, even with all the corruption in Mexico and some other places. You don't run into that. The utilities are sound in Bogota, in São Paulo, Brazil, in Rio de Janeiro, in Mexico City. So people do those things themselves. Like the high earners in South Africa have their own power, it's their own security.
So they're working from home largely, with their own generators.
Yeah, they have their own office outside of their house. Like again, $4,000 or $5,000 a month in South Africa is $200,000 a year in the United States. So they have large homes with separated offices and their own power. They have to do their own power because the government doesn't solve that for them.
And Nick, what of the time zone difference? So we all understand that that's complicated in the Philippines. Anybody who's worked with somebody over there has to deal with that. Sometimes you can have people work Philippine nights, our daytime. There's a debate whether or not that's effective. But when we're talking about management, your actual your executive team being on a different time zone, how do you deal with that?
Yeah, so 5 o'clock Eastern time is 11 p.m. in Joburg. So it's not. They don't have to They don't have to live a different life, if that makes sense. Your Filipino talent, your India talent, your Sri Lankan talent, your Pakistani talent, they have to live a different lifestyle to work for a U.S. business. 20 million people in the Philippines do. 20 million people in the Philippines do. And it's almost all the high earners do in the Philippines, frankly. I love Latin America. If you don't need the professional maturity to deal with bankers, clients, customer, sales, high-end sales, if you don't need the professional maturity and the smooth British accent, hire in Latin America. just do it, because they're on the same time zone. For $480, we can get our team in Bogota, Colombia to Atlanta, Georgia for an outing in person. It's a 6-hour flight from Bogota. Mexico City's even shorter. So yeah, there's massive advantages to Latin America. But sales and finance, South Africa is the hub, and executive.
Nick, one of the ways that you were able to raise the money that you did is both all the way back in that first real estate deal, but also with Somewhere, is that your LPs, your investors know you. So in some cases, they're related to you, but in other cases, that you talked about, that broker in the real estate deal watched you go through the zoning and the permitting. Yours truly and 399,000 other people have watched you on Twitter, how you think. So people have invested in you because they believe in you, because they've gotten to know you either at a distance or up close. Say more about media in your career.
Twitter is a wonderful tool because it gives people a look into your mind. They see how you react to hate. They see how you react to people acting crazy and saying crazy things. They see how you argue. They see what your family values are. They see, it's a look in your mind. Like when I tweet, when I type, it is coming straight from my mind to hundreds of thousands of people, which is a crazy thing to think about. But I feel like I know people who I follow on Twitter. I don't know. I know them on a deeper level. I know a lot of it can be fake. A lot of it's not the same when you're in the room with somebody in battle, operating a company, or going through a tough investment or an economic downturn or whatever the stresses of life, right? But it gave us a good, strong foundation so that when I hopped on a plane and went to somebody's office and chatted with them about my business and how I think about things, there was a lot of barriers that were broken down previously that allowed me to accomplish more.
Yeah. Yeah. Well, I heard you say the word hate. So I want to press you on actually something that I'm experiencing right now, Nick, which is your Twitter persona, or I shouldn't call it a persona, but how you are on Twitter, because it is you. But it does feel at times more aggressive. It has been controversial. You've gotten hate, and I want to hear how you responded, how you emotionally dealt with that. But the question, but I'm experiencing you as frankly much more warm and cuddly than you come off as on Twitter. So it does feel like there was a little bit of marketing, or positioning yourself on Twitter. Some people would say, the aggressive tweets just travel better. So it was just widening that funnel. Talk to us a little bit about that. But then I really do want to hear how you deal with huge amounts of people saying unkind things. But first, your strategy on Twitter.
Yeah, I think the Twitter is a place where nuance does not help anybody. I'll just be honest. Nuance doesn't make people think, it doesn't spark conversation. There's no reason to read or engage with somebody who has nuance. So I have strong opinions that are loosely held. I'm not afraid to speak them. I'm not afraid to change my mind in public. And I'm also not afraid to goof off and say ridiculous things that, in my opinion, only anger the people who have nothing better to do than get angry. So I don't really care. But yeah, I'm a pick. I have a weird sense of humor. A lot of it is for fun. But yeah, if we transition to the hate, I guess it can get really tough and really brutal. Like I was under a full-on attack from a anonymous account for 3 months last summer that took an insane emotional toll on me and even my family. So yeah, it's not for everybody. Like if you want to be worth following on X or on Twitter or anywhere, you have to bring a new perspective, and you have to be willing to put yourself out there. You have to be willing to look foolish. If you're super insecure about everything you send, you'll never type and send anything on the internet. On one side of that coin is massive career advancement and opportunities to get in rooms that you never thought you would get in. Like being here, sitting with you, talking to a bunch of, your audience is insanely driven, and just getting in these rooms, it would never happen without it. On the other hand, the hate and the harassment and attacks are just part of what you have to live with if you play this game.
And for people who aspire to build some sort of media something, and even maybe get quite big one day and have to deal with hate, for lack of a better word, is there a way that you can tell them to accelerate how you've come to accept it? Because I assume the answer is, and I'm sure celebrities, proper, Hollywood style celebrities also deal with it, and you just build a thicker skin, and that's the answer. There is no hack. It's just building a thicker skin.
It's the Andrew Huberman PR approach.
And what is that?
When Andrew Huberman had all that crazy stuff come out about him, he didn't say anything for 4 months, and then everybody forgot about it. That's the best way to handle any situation. If you let yourself get worked up, if you jab back, if you let yourself emotionally get worked up, and this is such a lesson for actual business ownership, if you let your temper and your emotions get the best of you, only negative things can happen. Only negative things. So yeah, you look at the best basketball players in the world, 90% of the feedback they get online is hate. Every politician, all they get is hate. Look at their ex. All they get is hate. Same with movie stars, celebrities of any kind, business owners that are really big deal, anything along those lines. 90% of the feedback is always going to be hate, because the negative people are the loudest, and they're the ones who sit and thrive in these environments of anonymous situations. So it's just part of, but yeah, the answer is you have to develop thick skin, but man, it hurts. It hurts.
Yeah. The change in the Twitter algorithm. So here you are with 400,000 hard-won followers, and now the value has really collapsed in that. Is there a platform or media play of choice today that you'd prescribe to people?
I still think that some amazing life impact happened when I had 500 followers and 3,000 followers and 10,000 followers. So I would encourage deal makers, business owners to go in and talk about the deals they're doing and the business that they're doing. The problem is that the vast majority of people want to build an audience before they actually do something. And if you have no value to add anybody, you're wasting your time. But if you want to get a following and you want to expand your network of high performing people, 1,500 followers can change your life if you're a deal maker and you're in the right rooms and the right people are following you. So I still encourage folks to tweet, but don't expect or want to get to 400,000 followers. I get 1,500 new followers a month now. I used to get that in 10, 12 hours back in 2021. The difference, it's very, very, very hard to grow on social media today unless you're willing to do short form video on Instagram and have a cameraman follow you around all day. It's very, very hard. So I'm at a crossroads in my life. I still have a media team. We can talk about the makeup of that media team, how I invest in it. But I'm at a crossroads now of, hey, am I going to try to do both at a very high level, meaning operate companies and media? Am I going to try to do both at a very high level? There's people who do it, Alex Hormozy, others. Or am I going to focus on media, double down on that? Or am I going to focus on business and double down on that? I'm not great at short form video. I don't want to have a cameraman follow me around. So therefore, I'm at a crossroads of, hey, do I double down and keep investing massive amounts of money and time into media? Or do I just keep doing what I'm doing with the right audience and focus on building companies? So it's a tough dichotomy, but yeah, it's not easy to grow a massive following. And frankly, the massive following is not as valuable today as it was.
Well, when I think about a Hormozy or a Cody Sanchez, who's maybe closer to me and maybe closer to you as well in terms of audience, I'm sure they would say I built this massive audience because it opens doors, because of the business opportunities that come from it. But maybe they wouldn't, because I do suspect that at some point, both of them, not to pick on them, but they're are motivated by the draw of being known people. That it's an end in and of itself to basically be internet famous.
And I would lie if I didn't say that I had an ego as well and care what people say on the internet and how many people follow me and how many people buy my book. It's human nature for sure.
Yeah. And then this experience with the algorithm, how does it make you think about your list? I'm sure you have a big email list, and in podcasts where you started in podcasting. So those two platforms are, of course, the algorithm independent, totally quote unquote owned audience platforms, if you want to call them or media or technologies. So
Yep.
did it kind of cause you to refocus on those, or not necessarily?
I definitely focus on those. They're important for me, but it's really interesting. People go in phases, and I'm sure you experience this as a creator as well. People get very into your podcast and listen to every episode for 6 months, and then maybe they go back to it every now and then, but only a small few stick with you and me for years and years listening to what we do. So I'm on a float in a parade, and I have a moving audience at all given times. And my email newsletter ages out. People get tired of Nick Huber and what Nick Huber says, period. People go through phases of listening to Hormozi. They go through phases of listening to Cody, me, you guys. So if you're not always building your list gets less and less valuable over time too. It's all a rat race and a treadmill.
It's bleak, but it's such a good insight. It is such a good insight.
So I think the connections that you make and the true fans, and I do feel some new energy around my book and stuff like that too, but it's not a great time to be a creator online.
One of the things, and this is borrowing from Techland and practices from over there, is, in fact, your buddy Sean Purry says this a lot, that distribution, that it's all about distribution. And it's almost like I'd rather invest in an entrepreneur or a thing that has distribution unlocked versus how good the idea is itself, or the entrepreneur is him or herself. So you had this incredible distribution. I'm putting words in your mouth, correct me, but you started with this playbook. You launched all these businesses with the idea that you could just, direct your audience to them, and they you were going to be the one-man funnel for 10 different businesses. Yeah. I don't say that to mock you, because on its face, it seems like a very sound strategy. But some of those businesses haven't panned out at all. So react to, just because you have this incredible audience doesn't mean that you can just launch any business to it and the business works.
No, business is very hard. Business is hard for everybody. Making money's hard. I firmly and strongly believe that. And even with a lot of distribution, you can fail at business for sure. So I think I'm good at what I do. I have natural confidence. I have an ego. I have, the courage to take risks, but also business will humble you and humiliate you certain days. So yeah, like everybody wants to own a holding company is another thing. It's like a sexy thing to do now because of Brent, and Cody does it. I do it. Girdley does it. Hormozi does it. A lot of people own holding companies, Sieva and Xavier with Enduring. So it's the sexy thing. It's in 9 out of 10. And I'm about to speak out of two sides of my mouth. This just goes to the nuance of business. I'm very lucky that in 2015, I got distracted and built that first self-storage facility. I'm very lucky I said yes to Marshall to get involved in somewhere.com. Very lucky I started RE Cost Seg. So those 3 businesses changed my life. If I was solely focused on one business, I never would have done that. I'd still be moving boxes and stressed out during the storage season, making $500,000 a year max. But on the other hand, on the other side of it, the wealthiest people that I know, 9 out of 10 of them started one thing and did one thing really well. It's just truth. It's the truth. So how do you balance that in your head as an entrepreneur? I don't know. But yeah, I started 11 companies, a web development agency, a sales consulting agency, a pay-per-click digital marketing firm, an insurance company, a US-based recruiting business. The US-based recruiting business, the sales coaching business, and the web development agency are shut down. 3 of them are shut down. The middle 5 are doing well, and they have potential. And then the 3 monsters emerged. It was a power law in what emerged from the efforts that I had to start these new businesses.
And if you had to pinpoint why having incredible distribution didn't just make it work, what was it? You underestimated the operations and all the other things that make a business a success, basically? It's not just about filling the funnel?
Yeah, it's operationally difficult to run a business that starts to grow. It's operationally hard to hire great management that cares and compensate them in a way that keeps them motivated and at your company. A lot of good decisions have to be made to build a big, good, sustainable business. So yeah, it's difficult.
One more question on the media stuff, Nick. You are talking about, or at this point where you're wondering whether or not you double down on media and go big or not. I gather you have a media team now?
It's interesting because my media team is kind of morphing into operators that parachute into companies to work on certain things. Like my head of content is Colin. He lives in New York City, very well paid. He manages my full media team. He schedules my tweets. He schedules my Instagram posts. He schedules my LinkedIn. He helps me form my newsletter from content that I've written. His team edits my podcasts. I have 2 podcasts that are released every single week. So a ton of work goes into that. Colin leads the team. He's the CEO or the head of media for me. He has 6 people on his team, 2 executive assistants, a video audio, a graphic designer, and a web developer. Interesting thing is that Colin is playing head of growth, head of marketing at Somewhere right now for this month. And our web developer is full-time on Somewhere too right now. And then Colin will parachute into RE Cost Seg and talk to the marketing team over there, and we'll implement a lot of the things that are working at Somewhere into RE Cost Seg, and we'll go over to Bolt Storage. And so my media team is almost morphing into an operations team to enable my businesses while also running my media stuff. So yeah, I probably, if you count Colin plus my 6 employees, I'm investing $350,000 to $400,000 a year in payroll for my media company.
Wow. Yeah, you better decide what you're going to do with that.
It's still very worth it at this point. It's still very, I'm still able to drive a lot of leads to my businesses.
And so what does your portfolio of media products look like? You ran us through them there, but what do you post specifically? How much? It seems like it's extremely dynamic, how you treat media and what works and what doesn't.
Yeah, I think half of what you see on Twitter is me in real time tweeting. The other half is scheduled posts from my team from past things that, like, again, media is a parade. So the audience is new all the time. So I have to repeat and replay the bangers, or those are going to just disappear because people are going to forget them. So we repost it on Twitter, LinkedIn, Instagram, Threads, Facebook. And then I run a newsletter that goes out every Monday. That's deeper, more intimate about operating companies, sales, delegation, hiring. That's an email that goes out every Monday. Then I have 2 podcasts, the Nick Huber Show, which is real estate, the Sweaty Startup, which is small business. And yeah, then the book is a big endeavor that my team has kind of released and launched. So,
and how many posts do you do? Is there an upper limit to how much you should be posting? Because Alex Hormozi effectively says the more the better.
I look at it as I only have so much attention that's going to come my way. So every post is a bullet that I'm using in my gun that day. And I have 5 or 6 bullets to shoot in a given day. That's how I look at X.
And so, Nick, with your team of Colin plus 6, you said 350 to 400 a year. So that's what, $30,000 plus a month. How many hours a week are you personally devoted to or creating media?
Well, the book launch has been intense. I've done 70 of these 1-hour interviews. So over 2 months, that's, 6 hours a week of this. I took a lot of time to actually write the book, 1,000 hours over 2 years. So yeah, it's been, but then this week, outside of this interview, I'm, really deep in Somewhere, like going to put 40 plus hours into Somewhere this week. So yeah, it varies. Okay.
But maybe outside of launching a book, writing and launching a book, could you give us a rough estimate of how many
hours? 3 hours a week of productive media stuff, and then probably another 3 hours a week of just wasting time on X.
Okay.
Well, that's not bad at all. I think most people waste 3 hours a day on X, just normally consuming stuff.
I have 30 minutes a day and before it shuts off on my phone, and then I probably spend another, 15 minutes on my computer on X too. So,
yeah, no, very cool. I knew I would enjoy this conversation ever since I learned your full name was Nicholas James Huber.
We do have something in common there.
Listening to what you're telling us, 2 pieces of a secret sauce emerge to me. One is the media presence that you're investing heavily in, and it's giving you access to investors, opportunities, deal flow, clients. And then the other secret sauce that really intrigued me was you talking about remote work and how you have built a competitive advantage with your companies hiring abroad, where you can get not only cheaper talent, but talent that is available around the clock and are specialized in a way that enhances quality for your company. So looking at these two secret sauces, and maybe you have more, but what does the future look like for a serial entrepreneur like you?
Yeah, I think I'm super ambitious and overly confident, and I've written a lot of checks in the last couple of years, and now I got to go cash them. I raised a bunch of money in my storage portfolio. It's been chaos the last 3 years in storage. We refinanced all of our properties without any cash in from investors, which is more than 80-90% of real estate GPs can say. I'm very proud of that. I'm very proud of our operation there. But I bought a big business, and now I got to do with that business what I told my investors I was going to do with that business. So I am singularly focused on, growing these 3 companies: RE Costseg, Bolt Storage, and Somewhere.com. So I'm at a phase. I'm a firm believer in like seasons in the life of an entrepreneur. Like, you'll have a season where you don't work that hard, things are going great, you're making good money, and you'll have a season where it's time to throw down and do what you need to do. I'm in a season right now where I need to throw down and do what I need to do. If it goes well, it'll amplify everything, and I'm super excited about that. If it goes poorly, at least I'll get to say that I took the shot, and I won't regret it. But yeah, I feel a lot of pressure from the investors that are trusting me. I feel like I have a lot to learn, but I'm also operating with confidence. So it's a very fun and exciting time, but it's definitely a high pressure, high stress season in my life, and I'm kind of looking forward to not as much stress and pressure.
But you've talked about how there have been multiple trajectories in your career, and starting your own company, a moving company early on was one, and then getting into self-storage was the second one, and then buying a minority stake in Somewhere.com was a third one. And I totally understand as an entrepreneur that you're in a season and you got to kind of dig your head in for a while being now. But what are the next trajectories when you have the kind of defensible moat that you have built already and capabilities that you have and a network that you've built? What does that look like if you take a really long-term view?
Yeah, I have some very ambitious goals of what I want to do. I love nurturing talent and building companies. I'm excited to do more of that in the future. I would love to buy more companies in the future. I would love to write more books in the future. I'm very motivated by money and what you can do with it from a philanthropy standpoint and a generational wealth standpoint. So I'm super excited about the odds of me succeeding and making Somewhere massive and making RE Costseg massive and making Bolt Storage massive. So yeah, if things go well, the story that I'm writing right now as we speak in the background that nobody knows about will be epic, and I'll be proud of it. But if it goes poorly, the interesting thing about like just being a man and being an entrepreneur, you really tie yourself to these things. I know some women do that too, but mainly as a man, you have a lot of self-worth tied up in your business and what you do and how much money you make and how much success you have on the scoreboard that is cash, money. So if it goes poorly, I'll have to reset, and I'll be broken for a little while, but I'm going to bounce back. So I think the odds that it goes very poorly are low, but there's always a chance. Like, operating companies is a different thing. So I'm excited about the upside of these businesses that I'm running, but it's hard and it's fun and it's exciting and it's challenging. I'm learning a lot. I'm getting humbled, but I'm also getting more confident. It's a crazy, crazy time. So I'm super excited, but I have no idea. I have no idea what the future is going to hold. I like to think that someday Somewhere is doing, $250 million a year of revenue, but we got a lot of work to do to get there. You're
influential, accomplished, and opinionated. Do you think at one point you might get engaged in politics?
No way. I will build organizations, and I think with that will come influence, but I don't think there's anything it's just selfishly, there's nothing less rewarding or worse for your family than getting into politics.
Yeah, it's a zero-sum game.
I'm really thankful that some people do it. I think a lot of people in that business have a good heart and do it for good reasons. But man, it's really I can't think of much good that would come from it from a relationship and family standpoint. I'm really excited about my kids right now. My 7-year-old is amazing. My 5-year-old, I mean, they're so amazing. I'm so glad I made the sacrifice earlier in my career to have kids. I had my first kid at 27. So glad I didn't wait, because I'm just enjoying that so much today as well.
Well, that's one of your it's not controversial, but strong takes that lands on some people controversially. Have kids early. None of this being single until you're 40, as I did, Nick Huber. Stuff.
There's obviously a lot of nuance to so much in life, and
of course,
my Twitter is, I hope people can look at it and realize that it is what it is as a broad message. But life's hard, man. Life's hard. So yeah. I think there's a lot going on.
Well, this has been an absolute blast, Nick. I was so thrilled that we were going to have this chance to talk to you about this very wide-ranging set of topics. You've been such a good sport, so transparent, especially unpacking that deal. We love transparency on deals. You gave it to us and then some. So we really thank you for coming on the Minds Capital podcast and acquiring Minds. Nick Huber, somewhere.com. Name of the book?
Yeah. So if look, I'm very accessible. You can email me, nick@sweatystartup.com. I read every email. If you want to discount it somewhere, you want to pick my brain about anything. But yeah, The Sweaty Startup is the name of the book. I think it'll add some value if you pick it up. So no, but look, guys, I really appreciate you giving me this microphone. Love what you're working on, and just thanks for having me.
Thank you, Nick. Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.